Hi, let's continue with financial and operating leverage. Let's look into the impact of financial plan on EPS and return on equity of the company under constant EBIT level. So there are two financial plans given here. The first financial plan is collect the NDA funds by way of issuing 50,000 ordinary shares or equity shares at rupees 10 rupee per share. This is the first financial plan. And second financial plan, raise 2,50,000 by way of issuing 25,000 equity shares at 10 rupees per share and borrow rupees 2,50,000 at 15% rate of interest. So these are the two financial plans. What's the difference in these two financial plans? The first financial plan deals with equity alone. So the company depends on the equity shares for raising the funds. Second financial plan, company depends on equity and debt for raising the funds. Company collecting the funds from insiders and company collecting the funds from outsiders. So this is a debt equity plan. And tax rate is 50%. So here the question is how the equity plan will influence on the returns available to the shareholders. How the debt equity plan influence on the returns available to the shareholders. Which plan magnify the returns available to the shareholders? That's a question here. Let's look into the example. Then we will understand which firm magnifying the returns to the shareholders. So here there is an assumption that EBIT level of both plans are same. Earnings before interest and tax. It's given here 1,20,000 under the equity plan, and under the debt equity plan also it's 1,20,000. And first financial plan, is there any payment of interest related to this plan? Not at all. Reason, this plan deals with equity alone. Equity is not related to interest. Only debentures, loans are related to interest. So under the first financial plan, the interest amount is 0. Yes, of course you put it here 0. And second financial plan, you borrow 2,50,000 rupees at 15% rate of interest. So 2,50,000 into 15 by 100. So you will get 37,500. That's the interest amount paid by the company. Okay, so this 37,500 you put it here. And you deduct this and you will get the profit before taxes. Okay, after deducting the interest you will get profit before tax. So what's the amount? Let's look into that. 1,20,000 minus 0, the amount is 1,20,000. Here 1,20,000 minus 37,500, 82,500. That's profit before tax. Okay, then the tax rate is 50%. You know that tax is always charging on profit before tax. So 50% is charging on this 1,20,000. You will get 60,000 rupees tax amount, put it here. And here 82,500 rupees you are charging 50% and your tax amount is 41,250. You put it here. Then you deduct the tax from the profit before tax, 1,20,000 minus 60,000. You will get profit after tax, that amount is 60,000. And for the second company, that second plan, debt equity plan, the total amount is 41,250. So now you got profit after tax. So the next column, total earnings of investors are written here. So that's not very important here. And number of equity shares. How many equity shares are available under the first financial plan? It's very clearly written that 50,000 equity shares. So you write that 50,000 here. And second financial plan, 2,50,000 equity share, 2,50,000 equity share capital and 25,000 ordinary shares. So you are writing the number of shares 25,000. And you must calculate the EPS. What's the formula to EPS? EPS equals net profit after tax divided by number of shares. So 60,000 divided by number of shares. Number of shares is 50,000. So you will get EPS 1.20. And second plan, what's the EPS? EPS is 41,250 divided by 25,000. You will get 1.55. That's EPS. So you can calculate the return on equity also just like that. So you can just compare the EPS between these two companies. Equity company made EPS of 1.20, but the debt equity company's EPS is 1.65. Why this debt equity company able to give maximum return to the shareholders? You know that. It's only because of one reason, tax amount. Tax amount paid by the debt equity company is lesser than equity company. So the interest is a tax deductible expense. There is no need to pay the tax on the interest. That's the reason the company's EPS is actually very attractive. Debt equity plan EPS is very attractive. So what you can understand from that, if the firm is using debt along with equity in the capital structure, it will magnify the returns available to the shareholders. That's known as financial leverage. This is applicable under one particular circumstance. If the return on investment is greater than the interest rate, then definitely leverage will work out. Otherwise, leverage won't work out. So leverage always work out when the return on investment is greater than interest. The return on investment is lower than the interest rate, then this leverage or the usage of debt with equity never magnifies the returns available to the shareholders. Let's look into two types of degrees of leverage. Degree of leverage tells about the percentage change in one item with the percentage change in another item. Let's look into the degree of operating leverage. This leverage tells about how it affects on firm's operating profit, EBIT. So it's defined as a percentage change in EBIT with a given percentage change in sales. In simple words, 1% change in sales, how much percentage change in EBIT it will bring. So this is actually operating leverage. Let's look into the formula of degree of operating leverage. Degree of operating leverage equals percentage change in EBIT divided by percentage change in sales. If degree of operating leverage is 2, the answer is 2, what's the meaning of that? Very simple. It's nothing but 1% change in sales will bring 2% change in EBIT. If 1% increase in sales, that will bring 2% increase in EBIT. That's the meaning of that 2% degree of operating leverage. And next is degree of financial leverage. Financial leverage tells about how it affects on firm's EPS. It's defined as percentage change in EPS due to the percentage change in EBIT, which means that 1% change in EBIT, how much change it will bring to the EPS? It will be given by the degree of financial leverage. Let's look into the formula for that. Percentage change in EPS divided by percentage change in EBIT, that's known as degree of financial leverage. When you combine both of these leverages, operating leverage as well as financial leverage, you will get an answer. 1% change in sales, it will bring how much percentage change in EPS? You will get the answer to that question by way of combining both of these leverages together. This is a formula for that. Degree of combined leverage equals percentage change in EBIT divided by percentage change in sales. That's the formula for degree of operating leverage into percentage change in EPS divided by percentage change in EBIT. This is the formula for financial leverage. So you are multiplying the formulas for degree of operating leverage with the degree of financial leverage. Then you will get the degree of combined leverage or degree of total leverage. What's the formula for that? Percentage change in EPS divided by percentage change in sales. It clearly tells 1% change in sales, how much percentage change in EPS it will bring. You will understand from this degree of combined leverage. So all these leverages are very important. it will tell about the plans impact on EPS and EBIT. So it's very fantastic thing which you can see it from a lot of examples. Okay, thank you.